Hey everyone, my name's Dustin Miles with Momentum Multifamily. Super excited to have Mark Allen here today. Mark, if you could just kind of kick it off, would love to. A lot of people probably know you, but for those of you that don't, would love to get some of your background, and we'll go from there.
Yeah, sure. Hey, everyone. Dustin, thanks for having me on. Excited to talk about today's topic, and I'll see if I can paint it into a positive light. But Mark Allen with Colliers, Vice Chair. We were acquired by Colliers, I guess it's been 4 months ago or so. Relatively new to the Colliers family, but Colliers is the number two largest commercial real estate services firm in the world. And they've been making a big push recently in multifamily capital markets. I grew up in Florida, went to school in New York, served in the military, and then made my way here to Dallas in 2016. And so I've been brokering really since the end of 2016 in Dallas, Fort Worth, in multifamily. And it's been a fun, maybe I say roller coaster ride with the ups and the downs, but there is light at the end of the tunnel.
Awesome. Well, I'm not. Hopefully, it's not a. I don't know. Did you make it out to NMHC?
I did, yeah. NMHC,
Okay.
I thought was kind of an opportunistic sentiment this year. You know, everyone wants to buy deals, and that there's not as much trading as there was, 4 or 5 years ago. But there are deals that are being made and deals that are happening, which maybe we talk about it a bit today. But a big difference from the global financial crisis, over 15 years ago, where there really wasn't liquidity. So that is a positive thing, I guess, for buyers. There's debt available, and there is equity capital available, despite it being more difficult to secure.
Yeah, well, I guess we'll we'll just kick it off on that topic then. Yeah, I guess if you could, you just listed a few of them, but any other differences between kind of 2008 GFC to now, just in terms of multifamily, some other differences?
Yeah, so 2008 was really a credit crisis. And so I mean, really, transactions came to a halt unless, they were financeable from Fannie Freddie, CMBS, bridge financing, bank financing. None of it was available. So a lot of the deals that were getting done during that time were all cash transactions. This time, now we have more of a broken capital stack issue. So many of the prices were purchased in 20, or the deals were purchased in 21, 22 at peak prices. Interest rates shifted. The Fed funds rate went from essentially 0% up north of 4%, and agency rates went from 3%, all the way up to at one point getting pretty near 7% before they started to subside. And I think today they're probably 5 to 5.5%. So today, I think one of the biggest challenges is really just the bid-ask spread. The bid-ask spread is still relatively wide. Last year, the list to close ratio in Dallas Fort Worth was about 25%. I look at that as kind of an indication of there was quite a few folks that wanted to sell, but maybe they didn't meet their pricing, so ultimately they decided not to sell. So I look at that as an indicator of the bid-ask spread.
Gotcha. Yeah, sounds good. Yeah, I wasn't around then. I kind of started right after that, and the few people I did know that started around then, they were mainly out of lifestyles. But I remember people, hey, we had to pay all cash for that thing. So,
Yeah.
so interesting. Uh,
Well, that's a big piece. Maybe I can share my screen too. Yeah, the other big piece was just the economy. Unemployment, really shot up to 10%. And so today we have still record unemployment. I think in Dallas Fort Worth, it's 4.3%. So like the distress was more widespread as people were losing their jobs, like they couldn't pay rent. I think right now we have a little bit of demand destruction with job growth that essentially I was looking at the numbers for 2025. Job growth is negative 0.1% in 2025 versus 1.7% in 2024. And then, 23 and 22 and 21 as well. So we actually were negative 1,500 jobs created. But I think we haven't seen the figures for net in-migration. Unemployment remains low, but jobs like, none were created. Wait, that doesn't make sense.
Mhm.
Well, the only way I think it can make sense is if population growth declines. So we'll see what that figure looks like. But generally, the short-term fundamentals have shifted with supply outpacing demand, but the long-term fundamentals for Dallas-Fort Worth or Texas as a whole has not really shifted. And generally, the demand is there where folks are paying. Occupancy has dipped a bit, but it's not like the global financial crisis from a macro perspective.
Yeah, gotcha. If you want, I gave you controls to share your screen if there's anything you wanted to share, by the way. But
Yeah, let's see. Let me pop this up. This is kind of jumping around a little bit. I think I'll hop back to that, but we got a presentation to give on Friday, and just this was something that a client shared with me that I thought was interesting. See if I can go to view full screen slideshow. Sorry.
oh, you're good.
All right, there we go. I just thought this was interesting as we're on the topic comparing to the global financial crisis. But if you look at on this picture in particular, it talks about the challenging second half of 2025. And this is from a client of ours, Rockport Equity, who's based out of New York. They target Sun Belt markets, so they own in Dallas, they own in Houston. They're targeting Florida and the Carolinas, and maybe, certain parts of Georgia as well. So, there's the most highest level of supply throughout the Sun Belt. Also, we think, we've seen some of the demand start to wane as well. So just interesting to see like demand here, and this is from real page data, has really fallen off in the second half of 2025. And occupancy shifted in the second half versus the first half was positive. So we really started to see a little bit of a slower market operationally in the latter half of 2025. And then this is interesting too. So basically, they're saying that the current downtrend is deeper than the global financial crisis. So some of this may be subjective as far as like are rents still declining? Well, it depends on the market and the submarket. But you can see just over the past couple of years, the negative rent growth is 10% versus 7.8%, which they said bottom late in 2009. Occupancy change, we're seeing more vacancy than the global financial crisis. Private values have shifted more, and then also REIT prices, which have now bottomed and have been on the upward trend. But just interesting to compare to the global financial crisis.
Awesome. Sounds good. Um, I guess where are you kind of seeing the earliest signs of distress kind of show up today, and would just kind of love to get your. I know you've kind of hit on some of that, but
Yeah.
yeah, would love to just kind of get your take.
Yeah, I mean, generally it's going to be, like I said, broken capital stacks. And I think, as we've moved along, the market has shifted a bit. But I mean, a lot of the deals that we're trading in 21 and 22 were trading, at 1.5 to, 4% cap rates. And then, buyers were underwriting very strong rent growth, oftentimes north of 5% because rents were growing at 20%. And that's, since has shifted. And so cap rates tend to be, anywhere north of 5%. Maybe on some of those Class A communities that aren't stable, you're going to have lower cap rates. Distress is ticking up. I think early on, the last 2 years, lenders were really in kind of an extend and pretend mode. And now, generally they're trying to take action. Some of the banks, I think, are, from some of the credit and agencies have some pressure, but also I think the debt funds are not seeing really a shift in the macro economy. They're not seeing a shift in interest rates. I think everyone was hopeful that the supply demand imbalance would shift. we would see positive rent growth, we would see interest rates come down, which would all lead to, an increase of value. Um, but generally, I mean, that's kind of what we're seeing today.
Okay. And are you, I guess, are you getting a lot of your BOV just kind of requests and all that? Is that picking up lenders, or do you have a percentage of, lenders versus your typical BOVs?
I don't have a percentage, but I mean, there's definitely been an uptick. So I think there were 9 foreclosures in 2024. There were about 50 foreclosures in 2025. Many of these lenders, they have a cost of capital. So some of them were securitized. They would loan on their balance sheet and then replenish their balance sheet through securitizing in an open CLO market. And so oftentimes, if there's a distressed deal in that tranche of loans, they can pull that out. There's a lot of flexibility, and they can do with it as they see fit. Well, when they pull that out, they've essentially got to buy it out of the pool. And so, I mean, if they have to start doing that a ton, then that affects their balance sheet and their cash position. So what many of them do, some are unlevered, but many take leverage in those scenarios. So there's a cost of capital associated with that. So they've got to make decisions like, do we take the loss? Just like an owner that maybe is in that same position, do we take the loss? Do we do a capital call? Do we do a cash in refinance, whatever the case may be? So they're making some of those same decisions. And honestly, I think they're in a similar position where it's like, hey, if we lose investors' money, it may be more difficult for us to go raise funds in the future.
Yeah.
So it's interesting to see the similarities between, owner or equity versus debt.
Yep. Yep. I guess of the it feels like the deals coming out are I guess pretty light so far this year. It felt like there were quite a few that came out. I don't remember exactly, but kind of maybe later Q3. Felt like there were a lot of deals coming out. Any reasoning behind I guess maybe where that Q3 rush, as far as deals coming out, and then maybe the lack of deals coming out. I guess that being said, I just saw on LinkedIn how I think you have a few coming soon too. So
I think there's a wave coming out. We've been involved in a lot of evaluation and advisory discussions with folks trying to make decisions, and I think many of those decisions started to come to a head, like in the last few weeks. So I know there's been some listings that we've unfortunately missed out on, but fortunately there are some that we have since signed. So. I think there's a wave of deals coming in February and March, and I think there's a good chunk of those that are lender-owned deals, and some of those lenders are willing to take a loss. Some of them are not, so we'll see what trades. Some of them are willing to get creative and provide. Um, I mean, if they own the asset, essentially seller financing, so accretive financing terms, maybe 85 to 100% loan to value. They may offer a fixed rate for a period of time, and do some creative things to help essentially engineer out their loan basis. Because, like I said earlier, they don't want to take losses,
mhm.
and some are a little more sensitive to that than others.
Okay, got it.
Yeah,
Are a lot of the deals, I guess the wave of stuff coming out, is it, older, newer, all across the board? What does that look
yeah.
like?
So about 40% of the trades last year were 2010 and newer.
Okay.
And about 40% were pre-90s and newer. So that was actually surprising. There was an uptick from 2024 to 2025. Um, I think it's likely going to be very similar this year, where most of the 60s, 70s, 80s product, we see the most distress there because there's the least liquidity. Many of the developer deals or the 2000s and newer communities that were purchased on bridge financing. There's just so much more capital available for that.
Hmm.
So many of those equity partners are willing to provide the capital needed to do a cash and refinance, or there's liquidity out there to recapitalize those deals and replace the existing equity partner. So we're seeing a lot of that. The distress is more in the pre-90s space. So I guess to answer your question, all in all, I think it's probably going to be similar to that, where you're going to have a good balance between, the two, new and old. I think last year I looked at a lot of the pre-90 stuff. Generally, about 50% of the trades were maturity driven. You still have quite a few owners who have maybe, I mean, maybe they've held the asset for 20 years, and it's an 80s vintage asset, and they feel like it's time to trade up in quality.
Hmm.
There's still, there could be partnership disputes. That's common. Maybe it's just someone that bought, 8 to 10 years ago, and they were able to move NOI considerably, and that they'd rather, sell today than continue to hold, I guess, with uncertainty in the future. Because, I mean, I think a lot of folks maybe went in with 5, 7 year time horizons, and all of a sudden, they're like, hey, we're at 7 years. Like, it could be another 2 to 5 years before we get to the other side of this. And do our investors want to stay in for that long?
Yeah.
So that's a hot topic of conversation and reason for some of these sales recently.
Yeah, I know we have a deal that's coming out that it bought in Abilene. We bought it 7 years ago, and it's kind of come to a point where we need to refi, or and put inject some capital back into the asset, or we need to sell. And so we're selling because it's in Abilene, and Abilene kind of has Stargate, and has the AI buzz and all that. So we're going to try and capitalize off that. So I know that's but we otherwise we could hold it for a few more years, but it really needs some more capital injected. So
Yeah.
yeah.
Yeah, I mean, and no one knows what the future holds. Right now the job market is relatively weak. And so, that's really affecting demand. And I think, kind of people moving around. Obviously, a lot of folks are locked into low interest rates, so that's affecting people moving around the country. Uh, so, it could turn around a year from now. No one knows. It could turn around in 5 years from now. So just with that uncertainty, I think a lot of folks are getting to a point where it's like, because of the uncertainty, we just want to sell.
Yeah. 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 I don't know. We didn't talk about this, so we can, kind of keep going. But I don't know if you have. I know you kind of put out on LinkedIn, yes, and deals coming soon. I don't know if you want to talk about those or the situation there at all, or if not, we can kind of move on.
You cut out a little bit there. I don't know if it was on my end or your end, but generally, I think I got your question. Just for deals coming out. Yeah, I mean, just from a high level, there's two deals that we're bringing out later this week that are, roughly about 230 units, 1970s vintage, one in Fort Worth, one in Dallas. And essentially maturity is looming. It's about 13 months away. They structured a loan modification. The loan modification terms reset in May, and so their cost of capital significantly increases, and they're already feeding the property on a monthly basis. And so, it's time to go to market, and see what we can gather. Fortunately, the lender on that is willing to provide some creative financing, which may, help the deal out, and may help, just because the size of the deals we're in the upper teens on those. And so, to raise the equity could be a challenge in today's market, based on the vintage. And so, I think those lenders that are willing to offer, 80, 85, 90%, value kind of help, reduce the capital raise for many syndicators. We've got two foreclosures coming out to market. Both are 1969 vintage deals. One's in Dallas, one's in Fort Worth. Both are about 150 units. One's in the 50,000 unit range. Lender's taken a significant loss there. And the other one's in the mid 60,000 unit range in Dallas. Um, so that'll be compelling. We've got boutique deals in East Dallas. Same thing, kind of the lender had foreclosed on a tranche of properties, and that owner is trying to sell and get out from underneath some of those loans. We've got other foreclosures, and like in tertiary markets, student housing asset as an example. And so I don't know. There's a lot more deal activity coming, I think, for us, and a lot of these discussions that we've had. Like I said, I think a lot of it's come to a head over the last couple of weeks.
Yeah, gotcha. Are I think I've seen either it was a LinkedIn post or I can't remember, or maybe we verbally talked about it, but do you have any numbers as far as number of deals closed for 24 versus 25 or uh, anything like
Yeah,
that?
it was 108, and just Dallas Fort Worth. It was
Yep.
189 sales last year, and that's across the board. 189 sales versus 208 in 2024.
Okay.
The volume was up, sales volume was up, and that was predominantly because 40% of the sales were 2010 and newer.
Hmm.
Um, Prices were down across all decade vintages.
Okay.
Um, and so, I mean, some of the data oftentimes can skew that based on, what if there's a higher concentration of, properties and, new construction properties in Frisco trading, as an example. But generally, we saw prices down about 4.6% year over year across all decade vintages. Um, but yeah, I think.
Did you have any data on, I guess, deals that are listed versus deals that are closed, or deals that are under contract versus closed, or anything like that?
Yeah, we pulled the data from August of 25 to September of 24, and it was right about 25% in the market. So that was, I think it was 44% in 2024, which was up from 2023. And so again, I look at that as an indication of bid-ask spread.
Hmm.
So it was down again, which is interesting. Another item was that the number of off-market transactions doubled in 2025 versus 2024. And I think that's partly just because there's owners that some of them need quick sales. Like they don't have time to go to market because some of these decisions need to be made, ASAP.
Yep.
Conversations are fluid with lenders, with equity partners. Um, and so I think that was probably, the big reason. If you looked at the share of off-market deals, it was primarily in the workforce housing sector. And I think the majority of those that we tracked were generally kind of like distress situations.
Okay. Gotcha. Yeah, sounds good. And then I guess are we how long, and I know you don't have a crystal ball and none of us do, but do you have a feel for, I guess, so we as an owner operator, I see it as an opportunity to buy, feel like there's good opportunity at least over the next year or so. Do you have a feel for, as far as number of foreclosures? Are we, where that, peak might kind of hit like over summer or kind of later in the year, or do you have a feel for any of that?
Um, I would like to think that we're now in kind of the second phase, like mid cycle phase, which is more resolution,
Okay.
versus recognition. And so in that resolution phase, is lenders taking action. So lenders really towards the latter half of last year, like I said, foreclosures were up 5 times in Dallas Fort Worth.
Hmm.
But there was also quite a few receivers appointed on unsafe and substandard properties. Some lenders chose to sell notes. They were going out and to try to free up their balance sheet, they were just selling the loan versus actually selling the property. So I think to answer your question, I believe that the window is really here for the next 2 years. So I think 26, 27. I mean, there will be some of these opportunities in 28, but I think the big window has opened up in the latter part of last year and will last primarily through 27 and probably a little bit into 28.
Okay, got
And
it.
I think, and on that subject too, it's like a lot of these deals that were trading at 120 to 200 a door in the 80s vintage sector, are now trading for under 100 a door.
Mhm.
And so some of them at less than 50%, of their value at the peak of the market or where they sold. And so what as this kind of trickles through the market, it does put downward pressure on rents, and specifically in the competing properties in the submarket. Because if you're a new owner and you're buying a 70,000 a unit 80s vintage property that's 65% occupied, well, you're going to need to turn some of that tenant base. You're going to need to improve the property and then stabilize the property. And in order to do that, you're likely going to lower rents and potentially offer concessions. So, um, what that does is the competing properties all now need to compete, with that subject property by lowering their rents as well. So through most of last year, we saw the biggest decline in rent growth in the 80s vintage sector. And it was roughly about 5%. And I think a lot of it was because of the distress. And I think it's more widespread in like the higher density areas in Dallas Fort Worth, like a Lake Highlands or North Arlington, north of 30, West Fort Worth or East Fort Worth, where there's just a lot of competition.
Mhm.
Unfortunately, there's been some distress there that has really moved the market. So I guess all that being said, like as that trickles through the system or the market, like it's hard to have rent growth when those trades are happening, and there's a lot of downward pressure on rents. That's besides you know, like I said, weak job growth, lower in migration, supply that still needs to be absorbed, like all that kind of stuff. And I say all that, but I think it's going to be short lived. Like eventually, like it'll flip, and we'll start to see rent growth and the market picking back up. But I wouldn't expect that to happen over the next 2 years. Just that's my personal view.
Yeah, yeah, I gotcha. Is of the lenders that are contacting you guys for BOVs, are you seeing kind of, is it concentrated among, just a few names, or is it just you're seeing it from tons of different lenders, or what does that look like for you guys?
Um, I, I mean, I think it's across primarily the majority of the distress is going to be in the debt funds. Like, I
Yeah.
mean, Fannie and Freddie have distress. I think they've been dealing with fraud in certain cases in certain like concentrated areas of the country. But we don't see as much distress, specifically in Dallas Fort Worth, as we do in some of the other parts of the country for Fannie Mae and Freddie Mac. So a lot of it's the debt funds, to answer your question.
Okay. Yeah,
Yeah.
gotcha. Yeah, and
And I'll show real quick. Let me see if I can get back to sharing my screen.
oh, cool. Yeah.
I think this is interesting, and not to really like beat a dead horse or anything. But this is a list of all the properties that are 50 plus units in Dallas Fort or in the Texas Triangle and beyond, I guess, because we got some Louisiana over here. Can you see my screen?
Yes, sure can.
Uh, okay. Wait, did I drop it?
Nope, still see it. Yeah. So I
Yep.
guess what do the different colors mean? Oh, okay. I see it in the bottom right.
The
Okay.
different colors are multifamily properties by DSCR. And so anything that is red, you can see here like smaller red, orange is less than 0.76 to 1. So essentially anything under 1 is not cash flowing. Now the data is not actual, not taking the actual P&Ls from the properties. It's more directionally accurate. and it's to give us an indication of where distress is forming. And so you can see here, if I just scroll to Dallas Fort Worth as an example, you can see quite a bit of red across the Metroplex. Out of 37, almost 3,800 properties, there's roughly about 1,100 properties that are under a 1.0 DSCR. And so I think it just kind of ties to my to my last point is that people forget that the market doesn't shift overnight. I know, COVID was a black swan event, and there was a lot of liquidity injected into the market, and things did change relatively quickly. But generally, the real estate market moves really slow, and so I think a lot of this is concentrated in the pre-90s vintage space, and so I think there's some more pain to come over the next 2 years. And then I'd like to think once we work through some of this and the job market picks back up, as far as job creation and hiring, we'll start to see rent growth again, and we'll be on the other side of this. So again, fundamentals there for the long term. We're having some pain in the short term, but there is light at the end of the tunnel.
Gotcha. Yeah, it's a neat map. Um, cool. And then I guess, uh, is there any kind of, I know we've, talked a little bit about this, but any signals, as far as, we have a lot of, investors on this call and all that. Just, I guess, is there anything that you see that kind of tells investors, hey, this is the time to act, or wait, or, I'd love to get your 2 cents on that.
Yeah, I mean, we talked about job growth. So I think job and population growth picking, like starting to revert and go the other way. And ideally, I think north of 1%, but once it reverts and starts going the other way, that's a positive signal. The new supply pipeline is really falling off. I think there's 17,000 units expected to deliver. That's a 10-year low. So that's a big piece of the rent growth equation. And that's not just new construction, that's also the older vintage stock. So I think over the next 12 months, like it'll continue to trend down. And so that's positive. And then and really the other thing is just transaction velocity. And so I think as transaction velocity, the number of sales starts to pick up, and we see rent growth, I think prices will really start to appreciate as well.
Mhm.
Because when I started in the business, so 16 to 19, we relatively had pretty stable interest rates, like kind of hovered high fours to low fives, and maybe like right before COVID, it started to drop off, and we broke into the low fours or high threes. Um, but generally, like prices appreciated during that time. And our rent growth was roughly 4 to 10% in Dallas Fort Worth through most of that period. And so if we have stable interest rates where they are today, and we have positive rent growth, like we will have appreciation as long as the operational expenses stay at bay. And so I think, and unfortunately, I guess on that topic, we're getting some relief on property insurance. I think over the next few years, there's a lag period, but in the next few years, we'll get some relief on property taxes, which is our biggest expense in Texas. And also wage growth. Wage growth will start to subside a bit. So I think some of the payroll increases. It's become a little better market for some of the property management companies and owner operators from a hiring perspective. It's hard to find good people still, but um, people aren't jumping around for the next dollar like they were 4 years ago.
Yeah, yeah. It was really tough to keep people then. Felt
Yeah,
like we were having to, it felt like, our better guys, it felt like we were having a discussion every few months of rent, bumping up their pay. So, yeah,
yeah.
it was pretty tough. Um, is,
I was curious to. I mean, I think I saw you got a new deal that you're working on, and I know you closed one late last year, so you're finding some good opportunities.
Yeah, I think there's some good opportunities in the market. Yeah, so we're excited about this year and think it'll be like you've kind of mentioned, it feels like there's a nice window of opportunity for right now. So we're excited for sure. And
You're
then
doing a lot of things. I mean, that's something as a buyer or owner in the market, like you've got to stay relevant, so you've got to stay active. It's hard to do deals, but that's even, when I say active, could even be building relationships with brokers. You've got to underwrite conservatively. You've got to be talking to your investors. You've got to be adding new investors if you're syndicating equity.
yeah.
In order to do that, you've got to get out there at events, not just locally, but abroad. And so I see you around. I saw you at NMHC from afar. I didn't get to chat with you, but um, you're doing what buyers should be doing in today's market.
Yeah, appreciate that. Yeah, just always trying to just learn and get a little better. So, um, one of the questions in the chat, I don't know if you have thoughts on AI on DFW's job and wage growth, if there's any effects there or not.
Um, I mean, like I was thinking about that this morning with population growth, I guess is down because I'm like, all right, you got low unemployment and you have basically negative job growth right now. So the only way that like unemployment stays low is either slower in migration, which I think we've had, but also labor participation. So there are folks retiring, but there's also, I think, some jobs are starting to be replaced, and I think that probably increases. But at the same time, I've heard that with a lot of these data centers being built and other various jobs, like there's my neighbor just hired an AI consultant to basically build out, I guess, systems for his company, and he manufactures and sells medical devices.
Wow.
So I mean that wasn't a job that probably existed several years ago, but now it does. And so I think along with that, there will be jobs created as they are, replaced. I don't know how that will ultimately affect, the job market and housing, unfortunately.
Yeah. Understood. I guess just kind of I'll leave a little bit of time for questions and all that too, but I guess just kind of looking at the rest of 2026, if you want to, there's a way to kind of summarize it. I know we've kind of bounced around a little bit and all that, but yeah, if you want to kind of summarize that and just and then we can maybe start taking some questions and all that here in a few minutes.
Yeah, real estate is really micro, market dependent, not as much macro. And so there are green shoots within various parts. I know of Houston and Dallas Fort Worth. Um, there was a deal that we were evaluating down in Cedar Hill fairly recently, and there was a deal we had on the market last year in South Dallas. And generally, like there's a healthy amount of demand down there as there is a growing population, but at the same time, there's not a lot of supply, and so there's a lot of properties in some of the southern suburbs that generally, and some of them have high incomes, they have great schools. They're just tougher for whatever reason, to get new construction projects off the ground. So there's not as much supply, and so we see those areas that have stronger rent growth, or less of a negative rent growth. Obviously, less concessions or no concessions. So there are areas that are still performing much better, than others. So just something to think about. But generally, 2026, I think will be, like I said, I think we're at the point of the cycle where it's like the resolution phase. So I think coming from NMHC, everyone was, I think, generally opportunistic because there's this basis reset starting to happen. There was even some buyers I mean, generally it's tough to buy in Dallas. It's very competitive. There's a lot of buyer demand. And so there's a lot of equity capital out there for 2000s and newer. And so a lot of buyers were really chasing that product, but not buying anything. And so there's been some buyers that I've spoken with that are now starting to dip back down into the workforce housing, back down into the 80s vintage, because the story is compelling. And there's, for the right deals, there's equity out there, even institutional equity. So I think that's probably in the workforce housing, that's probably going to be, the topic of conversation for a lot of this year is the reset basis, some of the distress. Otherwise, I think, in the Class A sector, there's still a lot of liquidity. I think that's picking up from a buyer demand perspective. And the infill projects, like a property in Richardson that was built in 2018, as an example, is probably going to get a heck of a lot more demand than something that's in, the McKinney corridor, like, Anna Melissa or Princeton or something like that, where there's been a lot of growth and a lot of job growth in the area, but there's also a lot of supply. And so that supply, it's just hard to make those deals pencil when, they may be stuck at 80% occupancy and they're offering 8 to 10 weeks of concessions. So, economically, they're maybe 65% occupied or something like that.
Yeah.
Um,
I was going to mention, I get asked all the time, especially I think from, typically kind of newer investors, they're like, how's DFW or how's Houston? And I'm like, well, it depends, just to your point about it being, it's very, market by or sub-market by sub-market. I know. Kind of at North Dallas, pretty tough up there. Frisco and McKinney and all that in terms of all the supply that's kind of come online. Are there some other pockets around town where you're seeing kind of maybe not as exaggerated as that, but similar concessions?
um, Southwest Fort Worth, Denton. Um, I mean, Sherman Denison would be one. And again, it's like it's almost like it's harder to pencil and underwrite, but if you can find an opportunity that makes sense, like those are usually the better deal in today's market. Because going in, the cap rate doesn't look good. They may be, you got to be very like opportunistic. And so I think there's going to be higher upside on some of those properties in some of these high supply areas. You just got to model or know that there may be some short-term, pain, so to speak. But usually because of that, you can get, better basis opportunities.
Yep. Yep. Yeah. Yeah, for sure. It's probably, kind of a little similar to Austin. I think you'd have to have super patient capital down there, just because it's even more challenging as far as the supply demand story. But yeah, I think you would need, yeah, you'd have to have patient capital and problem on our end and some of the other people on the call is when we're buying a deal, they're like, when are distributions going to start? And,
Mm.
if it's, so anyways, you just have to, it doesn't mean, just because there aren't distributions initially, does, necessarily mean it's a bad deal, but just, just kind of a different setup, different play there. So, um,
Right. Yeah, some investors are after cash flow, but those, well, I guess depending on the opportunity, some of those may be cash flow opportunities. Some of them, maybe more of them, may be more opportunistic with the pop on the back end at the sale or the refinance.
Yep. Yep. One deal, just kind of you were talking about the kind of basis reset. We saw a deal. I can't remember exactly what the buyer bought it for, and I don't recall they're all in, but it was, they're all in. They bought it, I think, for 150 or so. They're all in 160. It's being, the lenders all in, I think, is 120, and they're selling for 100 right now. So. Just it's a pretty, pretty good, part of town and all that. Not, it's not next to, anyways, good part of town, but just kind of, talking about that basis reset. I know there's been, because I live in Fort Worth, and so kind of Southwest, Fort Worth off of Fuel, and it feels like everything's trading, pretty much right now. I know. Becker buy a deal over there, and then there's one or two Olds Tides deals that are, I think I don't know if they've closed or not, but those were. I don't know what those were originally sold for. Probably quite a bit, but those are being, 80s product and being sold for, 85, 90 a door, something like that. So it's pretty interesting right now. Just in general, as far as kind of each of the classes, I think you've hit on maybe more of the Class A, but what sort of cap rate is each class kind of trading for right now in DFW?
It's tough. I mean, I generally say like 4.5 to 7.5, uh, everywhere in between. But I mean, there's a lot of deals that just aren't performing well right now. So they're not bought on a cap rate. They're really bought, for basis. Maybe, there may be two caps, but if you're going in taking that risk, like, you better be taking it to a nine cap.
Yep,
So it's a little bit all over the place.
gotcha. I guess
Yeah.
for like sorry to interrupt, more for like a more stabilized deal for A, B, and C, what are you seeing there cap rate wise?
I would just blindly say five, six, and seven,
Okay.
A, B,
Yeah.
C. But again, I mean, there's deals that are stable, that are 1968 vintage properties that have sold, for a 6.3 cap. It really
Okay.
just all the, it's like when we value deals, we're not just slapping a cap rate on it. We're generally, trying to underwrite it just like you would, and underwrite to either a target, yield on cost, or like a total return or levered IRR, like what's the return to the investors, or what's the average cash on cash return. And so, it's a little bit of a, not just science, but it's a bit of an art, as well.
Yeah, yeah. Well, and then like you were talking about too, if the seller or the lender is giving special terms or something like that, then that could, help kind of sweeten the deal too. So,
Right,
yeah.
right. And I would say, and maybe I'm promoting workforce housing, but you can't go buy a Class A deal for, maybe you're buying at 185 a door or something today, in one of these northern suburbs or whatever the case may be. Well, at the peak of the market, maybe it was like, 260 a door. But now there's these 80s deals that are, 50s, 60s, 70s, 80s a door. And again, they were double the price, just
Mhm.
5 years ago. And so not only do you have an opportunity, I think, to double up, on equity, but I mean, you essentially double your price, if it's timed well. So that being said, it's easier said than done, because I think a lot of these deals are broken that are selling at that lower prices, and they need local hands-on operators, to turn the properties around. So, I just say that because it's easier said than done.
Yep, yep, yep. Awesome. Yeah, trying to think if there's any other, I guess anyone in the audience, appreciate all of you hopping on. Let us know if you have any questions. But yeah, other than that, we may go ahead and wrap it up in the next minute or two, or a few minutes. Um, well, cool. Yeah, I guess, yeah, I don't know if I have any other questions. I just, yeah, really, we really appreciate your time, and that I can't help but staring at your map there. That's is that something is that your something that Colliers put together?
Yeah, right. I,
Okay.
I can't share this.
Yeah, no
It takes
worries.
email to log in to get, but maybe some folks have snipped it.
Yeah, yeah, no worries.
Yeah.
And then
And I,
someone had asked about, I guess, I don't know if you're able to share any of the slides. Someone had asked about that, but if you're not, that's okay too. So, um,
Yeah.
It,
Um, yeah, I think you have the slides. I know I didn't really present, through it as more of a discussion, but feel free
yeah.
to share.
Okay, sounds good. There was one question that came in. Mark or Richard asked if you're seeing, I guess, what you're seeing on the HFC side, and are those being sold? Are they hanging out for a while? Any movement there? I assume he means traveling.
Yeah, for the traveling HFCs. I've heard there's really no updates. I know there's a class action lawsuit. They're trying to get that ruling overturned or that law that was put in place overturned. Um, there has been a couple of opportunities that have gone to market. Um, with HFCs in place. I mean, these two deals, the one in Dallas and Fort Worth that I first mentioned, both of those have HFCs in place. But in that case, I guess if they trade, they'll trade, the latter part of the summer. And as it stands today, the property tax exemption benefits sunset January 1st, 2027. So
Yeah.
um, may at this point um, be able to capture only just a couple of months of property tax free. Um, so, I mean, we'll continue to track and see what kind of if anything is changes with the traveling HFC law, but I think most don't expect it to.
Yep. Yep. Sounds good. Yeah, we've seen a few of them where I guess they're out of runway, or maybe their lenders still requiring them to escrow for taxes and all that. So I think they're just selling because they're kind of at the end of the road. So
Yeah.
um, yeah, we've seen that in a few instances, Richard, where the deal's been sent to us and we're like, oh, it has, the traveling HFC, and they're like, just disregard that is what we've been how we've been guided. Um,
Yeah. I mean, it's a bit of a mess. Some of those deals got through with Freddie Mac financing. And I've valued two of those recently. And because of the property tax exemption, they got more loan proceeds than they otherwise would have.
yeah,
And so they're all worth less than the debt, which, puts the owner in, big trouble because they're going to have to come out of pocket to get a sale done.
yep, yeah. I know. I think there was. I can't remember exactly when it was, but I think if you had a traveling and you had the application in by, I think it was like sometime October, then basically Freddie would have honored, doing the deal, and now, yeah, it's kind of a mess all around. Do you know how many traveling deals there are by chance, in DFW or Texas or
I've seen a number in the past, and honestly, I just forget.
yeah,
But
yeah.
I would imagine there was a couple hundred.
Okay. Yeah, I couldn't remember the number either. I saw James Ing got on here. He probably knows that number, but yeah, I just can't recall. So
Yeah.
um okay, yeah, and when I'm not sure exactly what you mean by can the screen be opened after the event? But if you want to message me, I could try to help any way we can. So anyways, but well, cool. Well, really appreciate your time, Mark. And if there's anything that you want to leave people with, your website, whatever you'd like to kind of give out. Yeah, just appreciate your time, and always great time hanging out with you.
Yeah, no, thanks for having me and thanks for everyone for joining. Like I said, I mean, maybe some of the things I'm talking about are doom and gloom, but that is opportunity. There is a window of opportunity, so look at it on the bright side, and then also like I mean, this is just part of real estate. There's cycles, and so eventually it will cycle back. And for anyone that wants to reach out, you can reach me at mark.allen@colliers.com is the best way. Feel free to add me on LinkedIn if you'd like to connect with me there. And if anyone needs a presentation, I guess
Yeah,
you'll share that. Is that
yeah,
right?
yeah. I'm happy to. So, yep. Um,
Cool.
Awesome. Well, yeah, really appreciate your time. Great seeing you, as always. And then I'm putting your hope it's okay. I put your LinkedIn in the chat so people can connect with you there. And yeah, appreciate your time and look forward to seeing you again soon.
Sounds good. Thanks,
All
Dustin.
right, take
Appreciate it.
care. Have a great day, everyone. Take care. See you. Bye.